A man who has never run a Federal Reserve meeting in his life is sitting in a room in Washington right now deciding the next 3 months of your silver position, and he doesn't even know your name. That is not hyperbole. That is the literal situation unfolding at this hour. Kevin Warsh, sworn in as the 17th Chairman of the Federal Reserve on May 22nd, is presiding over his first Federal Open Market Committee meeting today, and at 2 o'clock this afternoon Eastern Time, followed by a press conference 30 minutes later, he is going to say a series of words that will move the price of silver more violently than almost anything else that could happen between now and autumn. I want to be precise about what I am and am not telling you. I am not telling you to buy. I am not telling you to sell. I am telling you what to listen for, because there is a meaningful difference between those two things, and the people who blur that distinction are the people who lose money on Fed days while telling themselves they were simply being prudent. Let us begin with where things actually stand, because precision is the only honest starting point for a topic this consequential. Silver opened this morning trading near $70.94 an ounce, according to live pricing from JM Bullion, up close to 90 cents from Monday and posting its best opening in more than a week. Trading Economics has it slightly lower, around $70.42, still up better than 0.5% on the day. Fortune's Tuesday print, taken at 8:30 yesterday morning, had silver at $70.39. These numbers cluster tightly enough to tell you something useful. Silver is consolidating in the low 70s, neither collapsing nor sprinting, the way a market behaves in the hours before it receives information that will actually move it. The gold-to-silver ratio sits in the low 60s, which by historical standards remains elevated, meaning silver is still cheap relative to gold by the standards of genuine bull markets in the metal. And zoom out for one moment, because the year-over-year number deserves to be said plainly. Silver has gained more than 90% over the past 12 months. That is not noise. That is not a speculative spasm. That is a market that is fundamentally repriced. Now, why does the chairman of the Federal Reserve matter this much to a pile of gray metal? Because silver, more than almost any other widely held asset, trades on the relationship between the price of money and the price of holding something that does not pay you interest. When the Federal Reserve signals that the cost of borrowing dollars is going to stay low or fall, the opportunity cost of holding a non-yielding asset like silver drops, and money moves toward it. When the Fed signals the opposite, the calculus reverses immediately. This is the entire mechanism, and it explains why the words coming out of one man's mouth at 2:30 this afternoon carry more weight in the short term than every mine in Mexico and Peru combined. And here is the history you need, sitting in your mind before this afternoon, because it is not theoretical and it is not ancient. On January 30th of this year, President Trump announced that Kevin Warsh was his choice to lead the Federal Reserve. At that exact moment, silver was trading above $100 an ounce, having touched its all-time nominal high of $121.62 the day before. Within 72 hours of that single announcement, no rate hike, no inflation report, nothing but a name, silver fell 42% from its peak. The iShares Silver Trust suffered its worst single trading day in its history. That collapse happened because Kevin Warsh's reputation, built over years of public commentary and Federal Reserve governance, is associated in the minds of professional traders with one idea above all others: a Fed willing to keep money tight and rates higher than the market wants, for longer than the market wants. That is the shadow Warsh carries into the room today, and it is why his first words as the actual chairman, rather than the nominee, matter as much as they do. Here is what is genuinely scheduled to happen this afternoon, confirmed across multiple outlets covering the meeting. CME FedWatch data puts the probability of the Fed holding its target rate steady at 3.50 to 3.75% at somewhere between 97 and 98%. Nobody serious is debating that outcome. The drama, and there is real drama, sits entirely in two other places. The first is the Summary of Economic Projections, the document that contains what traders call the dot plot, where each of the 19 members of the committee anonymously marks where they believe rates should sit at year's end. As of March, the median projection still showed one rate cut remaining in 2026. The expectation heading into today, reported by multiple outlets including Tech Times and Reuters-sourced analysis, is that this single cut gets erased, and that some number of committee members may now be projecting a hike instead. The second flashpoint is Warsh himself, who has spent years publicly criticizing the dot plot as a flawed exercise in false precision, and who is reportedly considering declining to submit his own dot altogether, a move that would be largely symbolic, but would send an unmistakable signal about how he intends to run communications at the institution he now leads. If you are the kind of person who wants to understand markets rather than simply react to headlines about them, I want to ask you to do one small thing before we go further. Subscribe to this channel now, while you are thinking clearly, before 2 o'clock arrives and the noise starts, because what comes next requires exactly the kind of structured thinking I am about to walk you through. And I do not want you trying to find this channel again in the middle of a chaotic afternoon when every financial outlet on the internet is shouting a different conclusion at you within minutes of the same headline. What I want to do in the next part of this is give you 5 specific scenarios, ranked from the one that should worry silver holders the most to the one that should encourage them the most, along with the exact phrases to listen for in each. Because the words Kevin Warsh chooses this afternoon are not interchangeable. Some of them carry catastrophic weight for a silver position. Others are nearly meaningless, despite sounding dramatic in a headline. Knowing which is which before the moment arrives is the entire difference between making a decision and having a decision made for you by panic. Let me give you the 5 scenarios now, in the order that matters, from the one that should concern you most to the one that should encourage you most, because not all hawkish-sounding words carry the same weight, and conflating them is how otherwise careful people make expensive mistakes on Fed afternoons. The first scenario is the genuinely dangerous one. If Kevin Warsh uses any variation of the phrase, restrictive policy may be warranted, or if he says the word hike in reference to a future meeting, watch the dollar and watch it immediately. Based on what happened in January, when merely the announcement of his nomination triggered a 42% collapse from silver's all-time high, an actual hike signal delivered by the sitting chairman, carrying the full institutional weight of the office, would represent a different order of event entirely. Markets that are currently pricing perhaps a 30 to 40% chance of any 2026 hike could reprice that probability above 60% within minutes, and a move below $65 within the following day would not be a surprising outcome. The second scenario is meaningfully less severe, but still worth your attention. If the new dot plot shows more than 2 committee members projecting a hike for 2026, even while the median holds at 0 cuts, this tells you the committee is drifting hawkish faster than the market had priced in, even without an explicit verbal signal from the chair. JP Morgan's economists, in commentary ahead of this meeting, suggested the Fed should formally drop its easing bias from the statement language entirely, replacing it with either neutral wording or no forward guidance at all. That alone, without a single hike dot appearing, would read as a hawkish shift. Meaningful, but not explosive. The third scenario is the strangest one, and the hardest to call in advance because it depends entirely on how markets process ambiguity rather than information. Multiple outlets, including reporting from Indexbox citing E.Y. Parthenon's chief economist, have raised the real possibility that Warsh declines to submit a personal dot to the projections altogether, consistent with his long-stated skepticism of the entire exercise. If the dot plot arrives today with the chairman's own projection conspicuously missing, expect an initial sell-off in the first hour, somewhere in the range of 3 to 5%, simply because markets reach for the most cautious interpretation when something unfamiliar happens. The correction, if it comes, tends to arrive once analysts spend an hour explaining that withholding a personal forecast is not the same thing as signaling a rate increase. But that first hour belongs to the most anxious sellers in the market, and that is worth knowing in advance. The fourth scenario is the one the serious institutional consensus has actually clustered around, and it is mildly constructive rather than alarming. This is the outcome where the rate holds, as is all but assured, the dot plot median moves to 0 cuts for the remainder of 2026 without an explicit hike majority. The statement drops its easing bias language in favor of something genuinely neutral, and Warsh avoids explicitly flagging a future increase in his press conference. A Reuters poll of more than 100 economists found a clear majority expecting no rate change through year's end, and the base case described across multiple previews of this meeting matches this fourth scenario almost exactly. In this outcome, expect silver to dip modestly, perhaps 2 to 3%, and then stabilize as the prevailing narrative shifts toward relief that Warsh was not as aggressive as feared. And the fifth scenario, the encouraging one, has become more plausible specifically because of events completely unrelated to Federal Reserve policy. A U.S.-Iran agreement aimed at de-escalating their conflict and reopening the Strait of Hormuz is reportedly set to be formally signed in Switzerland this Friday, and that prospect has already pushed oil prices down toward a multi-month low, easing one of the core inflationary pressures that has constrained the Fed's options all year. If Warsh stands at the podium this afternoon and explicitly credits falling energy prices as a disinflationary development, using language that frames this inflation as geopolitical rather than structural in origin, that would represent a genuine dovish surprise relative to the hawkish expectations that have built for weeks. In that scenario, real yield expectations compress, the dollar softens, and the path toward the $72 to $74 resistance zone that several technical analysts have flagged opens up meaningfully, with 78 and beyond becoming realistic conversations rather than speculative ones. Now here's the genuinely important point buried inside all 5 of these scenarios. and it is one that almost nobody discusses with the seriousness it deserves. The first hour of trading after a Federal Reserve announcement is, structurally, the least informative hour of the entire trading day. It is where the most emotional, least considered selling and buying happens, precisely because professional money has not yet had time to read the full statement, parse the dot plot in detail, or process the actual substance of the press conference rather than its headline. The 2 o'clock and 2:30 candles on a Fed day are noise dressed up as signal. The closing price on Thursday and the closing price on Friday, after analysts have spent a full day picking apart every sentence, that is where you find out what the market has genuinely decided, once the overshoot in one direction has partially or fully reversed. There is also a structural story sitting beneath all of this monetary drama that no single Federal Reserve meeting can erase, regardless of which of these 5 scenarios plays out this afternoon. According to the Silver Institute's most recent World Silver Survey, the market is entering its 6th consecutive year of structural supply deficit, with the gap projected to widen further this year compared to last. Industrial demand from solar manufacturing, electric vehicle components, and advanced electronics is not a speculative overlay sitting on top of the price. It is a contractual, foundational source of demand that does not evaporate because a central bank chairman uses a particular adjective in a press conference. The world consumes something in the neighborhood of 1 billion ounces of silver a year, and mines produce roughly 800 million, with the difference drawn from above-ground inventories that have themselves been shrinking for years. That mathematics does not change this afternoon. What changes this afternoon is sentiment, leverage, and the short-term cost of capital, 3 things that matter enormously to a trader and considerably less to someone holding physical metal with a multi-year horizon. I do want to address the comparison some of you have likely encountered in recent weeks, because it deserves a direct and honest answer rather than dismissal. When Paul Volcker pushed rates to 20% in 1980 and 1981, silver fell from $50 to $11, a 78% collapse, and that is a real and undisputed piece of history. But the most aggressive scenario anyone serious is modeling for this cycle involves a possible quarter-point hike no earlier than the 3rd quarter of next year, contingent on inflation accelerating meaningfully from here. That is not Volcker's Federal Reserve. A market with a 6-year structural deficit, genuine and non-substitutable industrial demand, and a gold-to-silver ratio still elevated by historical standards is a fundamentally different animal than a market built on leveraged speculation by 2 brothers attempting to corner a commodity in 1980. Corrections during modest rate hike cycles in silver's history have historically run 2 to 4 quarters, not years, and even the most bearish realistic outcome from today's meeting is a painful short-term setback, not a structural ending. So here, finally, is what a sensible person actually does with all of this between now and the closing bell on Friday. At 2 o'clock this afternoon, when the statement and the dot plot release simultaneously, do not look first at the rate. You already know the rate. Look instead for the word patient or the word balanced inside the statement language. Either of those words signals a Federal Reserve attempting to project genuine neutrality, and that is the outcome markets tend to receive calmly. If those words are absent and the statement instead leans on something closer to policy remains sufficiently restrictive, that is the harder signal, and the market will not wait politely to react to it. At 2:30, when Warsh takes the podium for the first time as chairman rather than nominee, the opening 5 minutes matter disproportionately to everything that follows. If his early remarks acknowledge the decline in energy prices tied to the prospective Iran agreement, or frame recent inflation pressure as geopolitical rather than embedded and structural, that is the softer signal silver needs to extend its move higher. If his opening instead dwells on inflation as a serious unresolved threat with no acknowledgement of the energy relief that has shown up this week, expect the market to read that as the harder, more hawkish signal and to respond to it within minutes rather than hours. And whatever specific words arrive in that half hour, here is the discipline that separates people who come out of Fed days intact from people who do not. You do not make a structural decision about a position you intend to hold for years based on a candle that forms in the first 30 minutes after a headline. You wait, you let Thursday's close tell you what the market actually concluded once it has had a full day to argue with itself. You let Friday's close confirm or contradict Thursday. The 2:30 panic in either direction is not information. It is the sound of money that was never going to stay regardless of what Warsh said. I want to be honest about something else too, because I think you deserve directness rather than performance. Nobody, including me, including the most credentialed economist at the largest bank in this country, knows with certainty which of the 5 scenarios I described actually unfolds this afternoon. What I can tell you with confidence is which scenario the weight of institutional opinion currently leans toward. Something close to the 4th one, a hold, a quietly removed easing bias, a dot plot that drifts towards zero cuts without an explicit hike majority, and a chairman who is measured rather than alarming in his first turn at the microphone. But confidence in a base case is not the same thing as certainty, and the entire point of walking through all 5 scenarios rather than just the likely one is so that whichever version of this afternoon actually arrives, you are not encountering it for the first time in a moment of genuine surprise. There is also a piece of context worth holding on to that has nothing to do with Warsh personally and everything to do with the committee he now leads. The vote that ended Jerome Powell's tenure back in late April split 8-4, the most divided FOMC decision in more than 3 decades. Warsh is not inheriting a unified room. He is inheriting a committee with genuine public disagreement about where rates belong, and his first meeting as chairman is, in part, an exercise in figuring out how much consensus he can actually build before he says anything definitive about his own intentions. That matters for how you interpret today's outcome, because a fractured committee tends to produce more cautious, more hedged language than a unified one, regardless of what any single member, including the chairman, might personally prefer to say. If today's statement reads as unusually careful or non-committal, that is at least as likely to reflect an unsettled room as it is to reflect a deliberate signal about future policy. It is also worth remembering what makes this particular metal different from nearly everything else that reacts to a Federal Reserve afternoon. A technology stock or a corporate bond has no existence independent of the financial system that prices it. Silver does. It gets used in solar panels regardless of what the dot plot says. It gets used in electric vehicle wiring and industrial electronics regardless of whether the chairman uses the word patient or the word restrictive this afternoon. That underlying physical reality does not insulate the price from short-term monetary turbulence, as anyone who watched the 42% collapse in January can confirm. But it does mean the floor beneath this market is built from something other than sentiment, and that floor does not get rebuilt or torn down in a single afternoon, no matter how dramatic that afternoon turns out to be. So treat today the way a careful person treats any single data point inside a much longer story. Seriously, but not as the whole story. Listen for the specific words. Watch the dollar in the minutes after 2 o'clock. Watch how the press corps in that room reacts to Warsh's tone in the first 5 minutes, because seasoned Fed reporters tend to telegraph in their follow-up questions whether they heard something hawkish or something calmer than expected, and resist, as much as you genuinely can, the urge to treat the first candle as the final verdict. I want to know what you think happens. Before 2 o'clock arrives and this becomes a matter of record rather than anticipation, tell me in the comments which of the 5 scenarios you believe plays out, and tell me why. Are you reading the Iran agreement and the drop in energy prices as giving Warsh enough room to lean gently dovish in his first outing, the way a new chairman might want to start his tenure on a note of calm rather than confrontation? Or do you think a man whose entire public reputation rests on monetary discipline is, if anything, more likely to lean hawkish in his very first appearance, precisely to establish credibility with markets that are still testing him? I am going to read through the comments before this afternoon's decision lands, and I want to know where the people who actually pay attention to this metal, rather than simply react to headlines about it, think this is headed. Stay sharp this afternoon. Read the statement before you read anyone's summary of the statement. Listen to the first 5 minutes of the press conference before you read anyone's hot take about the first 5 minutes of the press conference. And give the market until Thursday's close, at minimum, before you decide that today told you anything permanent about where this metal is headed. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.